Hello everyone and welcome to Market Movers with me, Oriel Morrison. Now hold on to your hats if you are an investor or even a trader in the equity markets at the moment. Now we're seeing some significant swings in the markets on a global level. Here in Australia, the share market is down more than 10% from its highs earlier on this year in around April. So there's been some fairly hefty downside coming through. To talk us through this volatility today, we are joined by Carl Coppolingua, market analyst at Think Markets. Carl, welcome. Thanks so much for joining us today.
Thanks for having me on, Oriel.
What's going on? What's happening in the markets right now?
Well, right now we're having the tiniest of little bounce after yesterday's sell-off. And it always concerns me when you have, a sell-off of the magnitude we had yesterday and you just get a small bounce. And there's the oldest saying in markets is, you might have heard of the dead cat bounce. So, how high does a dead cat drop when you drop it from a great height? It's not very high. And that's usually a pretty good sign for investors that the big money is staying back. They are not ready to buy yet. They're just going to see how things play out. Certainly they may be around at lower prices, but right now, investors, the smart money's just staying back.
Are we in a bear market?
Well, technically not yet. So the official definition of a bear market is a 20% fall from the high, which off the top of my head was 76.33 for the ASX back in August last year. So I think, as you said, we're down about 10 or 11%. At our worst case, we're down about 15%. So not officially a bear market, but this one's starting to drag on. So as I said, that high was made August last year. Your average bear market, FYI, typically goes for around about 6 months. Now, there's a huge dispersion from the average, but we're going on 12 months without seeing a new high in the market. So it's from that perspective, it is quite unusual. It's quite an unusual length of time between now and a new high. So I'm going to say it feels like a bear market.
It absolutely feels like a bear market without a doubt. So if technically we're not there yet, and if you go by the true definition, as you pointed out, of a bear market, what could trigger a bear market, Carl, at this point in time?
Yeah, well, it's one of those times currently where there are many factors at play here, and the most obvious one is inflation. I don't think viewers are going to be surprised when I say that. But when you think about the inflation targets by our central bank, so the Federal Reserve over in the USA, they'd like inflation to be around about 2%. Over here in Australia, the RBA would want it to be around 2 or 3%. We're at 7, 8%. At the moment, and it was that big CPI print in the US that caused a lot of the pain. So inflation is one thing. What the central bankers are really worried about is inflation expectations. So they're worried that we're going to keep thinking inflation is going to stay up here. It doesn't have to stay at 8%. Even if we think inflation is going to be 4% for the next few years, that's a big problem for those central banks because it's double what their target is. And to combat that, well, in the toolbox, there's not a lot for them to do apart from jack up interest rates. And that is a big factor facing not only investors from what they can spend at the supermarket, which then eventually flows into company profits, companies borrowing money to invest, to expand operations, to grow their profits. It makes it harder to do as well, increases their borrowing costs. Lower profits for companies equals lower stock prices ahead, unfortunately. So, yeah, look, that's the major factor going forward. The other little sneaky one, maybe we'll discuss it at some time in this chat, is energy prices, because I think that's the key factor and the key question mark contributing to that inflation picture.
In what way?
Well, we're heading into the Northern Hemisphere winter. We know that many governments have been scrambling to increase those stockpiles. And there was a little bit of a news item out a couple of weeks ago. They got to about 80%. And the energy markets, energy commodities like your natural gas, both in the US and Europe, sold off a little bit. Coal pulled back a bit. But then people started to realise, well, that 80% reserves, that's only a few days up to about a week's supply. So it's not going to do you much good. So we've seen those energy prices creep back up. Last night in particular, both natural gas in Europe and the USA surged. And I think we're starting to see sort of the precursor to a potential crunch there. We all know what's happening with Russia, the supply that's been taken out of the equation, and after a little bit of a pullback in energy prices, they're starting to move up. So that's what I'm worried about, and I'm watching very closely at the moment.
So before we turn this into something positive and look at how investors can win at this time, Carl, talk to us about how investors should be protecting themselves in a market like this.
Yeah, well, look, I think there's a couple of ways to do it. And the first one is not be a sitting duck, because if you look at the history of markets, about 20% of the time we're in a bear market. So 80% we're going up, 20% we're going down. So I don't think you can ignore that 20%. It's pretty important. As I said, it tends to last for 6 months. They can go longer. They tend to wipe about 1/3 of your portfolio value off. If you go back to the GFC, over 50% of your long-term portfolios were effectively wasted if you didn't have a strategy for protecting yourself. So message number one is don't be a sitting duck. Don't just assume that the market goes up in the long run and therefore I don't have to do anything with my portfolio right now. I'll just wait it out. The problem is, for example, if you lose 50% of your portfolio, you need to make 100% of what you've got left to get back to break even. It takes many years for the markets to do that. So if you can avoid the loss, that's the key. A lot of our clients that we speak to, we're trying to encourage them. We're trying to get the education up, and we're suggesting the idea of having like a limit on your various investments. So you might say if something drops by 10%. I might sell a portion of it. If it then drops by another 5%, so 15% loss, I might sell another portion. So at least we're not just going to hold all the way down. If you look at some of your, quote unquote blue chip stocks that, like your Zips, your Appens, even something like Domino's, which people just assumed $160 was blue chip and bulletproof, now it's $60. It's going to take a huge amount of downside out of the equation. So I think that's the first step. Have a rule for protecting yourself. The second one potentially is to make money if prices are falling. Because let's face it, bear markets, everything's going down. So it shouldn't be that hard to use this strategy called short selling to actually profit from a falling market.
Well, there's the positive, isn't it? Turning it into a win at this particular point in time, which is a very difficult market for anyone. Now, Cole, we are going to be chatting again in a couple of weeks' time, so very much looking forward to touching base again. Thank you so much for joining us today.
Absolute pleasure. Chat to you soon. Bye, Oriel.
And that's all we have time for this edition of Market Movers with me, Oriel Morrison. We'll catch you next time.